Kitco News special coverage of Messari's annual Mainnet Summit is brought to you by Oasis Pro.
As any investment professional will tell you, it's all about beating that benchmark, baby. When it comes to tracking the relative performance of crypto and other digital assets, those comparisons become much more difficult, if not scarce. I met Nesto for Kitco News here at the Mainnet Summit in New York City, and I'm joined by Andy Baehr. He's the Managing Director of CoinDesk Indices, also a CFA and a former derivatives executive on Wall Street with a half a dozen different firms. So thanks for coming on Kitco. Appreciate it very much.
Thanks so much. Glad to be here, Matt.
Let's talk about this kind of the state of crypto indexing right now. I mean, the Bitcoin ETF is a big thing, pending. That's going to prompt demand from consumers as well as presumably investment managers, all of whom are going to want to know, how am I doing?
Right, for sure. And we feel that digital assets right now are in kind of an adolescent stage. They're trying to move out of this early adopter phase into early mass adoption, right? And those last miles of those kind of processes can be sticky. Think about when you're buying a car or you're buying a house or you're taking healthcare services or any other kind of financial service. You're really used to that last mile delivery, right? So while early adopters and pioneers might have gone out and gotten cold storage wallets and gotten Coinbase accounts to get their crypto, most people are going to want to have the familiar experience of having an ETF or having an advisor add digital asset exposure into a portfolio. So having a spot Bitcoin ETF, for example, is going to be a really easy way to unlock a lot of that last mile to investors.
And certainly not, presumably, the last of its sorts.
No.
The beginning.
Yep, that'll hopefully crack open the door to a lot more time spent on understanding digital assets, time spent on analyzing the impact of adding digital assets to traditional portfolios. Having everything in one bucket is going to make it much easier to think about things at a portfolio level and see the benefits that adding digital assets can bring.
So CoinDesk Indices has been around, I think, since 2014. Not really new to this, but you're the segment leader, which is certainly an enviable position to be in. How do you compare, the path of CDI to the Dow Jones and the other index operators out there? It's similar, but very different.
For sure. And, I grew up in the equity derivatives world. And one of the things that most people in equities enjoy, maybe take for granted, is the idea of a consolidated tape, right? If I look at a stock, I kind of know what its price is because the market structure gives me a consolidated price that I can know and that I can trust. In digital assets, there's no such thing, right? You have different pools of liquidity on different exchanges, and you really only know the price of that asset if you take information from those different exchanges. The robust way to do that, so that you can track it, trust it, and look at it at a streaming level, is to index it. We've been doing that since November 2014. XBX, our Bitcoin price index, has been ticking once per second. It underlies the Grayscale Bitcoin Trust and several other. We just announced actually last week it's going to be the settlement rate for a Bitcoin futures contract in Singapore with ICE. There are other big announcements that we have coming up for XBX. But it is the most used, most trusted, biggest AUM Bitcoin price index there is out there. And of course, we have that for a bunch of other single tokens as well.
What should an investor or an asset manager look for and expect from a crypto benchmark? Like what makes it good or bad, or what are the tricky points, the potholes and pitfalls?
For sure. Even if you leave the realm of single token digital asset, which I just explained, which just help you really understand what the true price of a token is, benchmarks and indexing in digital assets is very similar to other asset classes like commodities, let's say. You want to think about a whole pool of related assets. You want to have a big market benchmark. You might want to look at sectors. You might want to look at things that have certain implementation paths. You might want to look at things that have certain trading pairs on different exchanges. What investors should expect from digital asset indices is precisely what they should expect from traditional asset indices. Things that should mark a skillful implementation of a strategy, whether it's passive or active. And in cases where it's an active strategy, if a manager is able to produce alpha
Right.
that alpha should be measured against the benchmark.
Right. I mean, like even the ubiquitous, the Dow Jones or the S&P, those are always getting changed. They're active, price weighted. That has its proponents and enemies.
Right.
Cap weighted. Are we going to see those kind of nuances and favoritisms?
We already do, and I think that the marketplace is adopting that same kind of market cap or circulating supply weighted structure of indices. We employ that, and our CoinDesk Market Index, CoinDesk Market Select Index both employ that type of weighting. Given that you have a market with two giant tokens, Bitcoin and Ether, which make up more than half of the market capitalization of all of crypto, we have to think about other weighting schemes as well, so that you can make sure that the altcoins have enough voice in an index. So we do those as well. We have equal weight, and we have sectors that eliminate those two giant tokens, so you can focus in on the altcoins.
Now, we're obviously going to look at dollar Bitcoin here in the States, but it's a global currency. Does this all play out around the world? Different markets, different currencies, just flat rollout? How does that work? It seems like a daunting task.
No, it is a daunting task, and we take it very seriously, both in terms of which fiat currencies pairs those trades are most important to the marketplace. I just came back from a week in Asia asking that question. Do you care about Hong Kong dollar pairs? Do you care about pairs versus stable coins? The market right now wants to go where the trading is and where the best exchanges are. US dollar pairs and US dollar pairs which are traded on exchanges that US persons have access to continue to be the gold standard for understanding the price of a token. So if you think about the price of Bitcoin, the price of Ether, you're naturally going to think of a number which is denominated in US dollars without any stablecoin risk. So we are expanding globally with ideas and different types of ways to measure digital asset exposure. But right now, the marketplace is most concerned about US dollar pairs.
And yet, you mentioned the deal in Singapore. I've had, you were also tweeting, I think, about Korea Blockchain Week. I know CoinDesk was there.
Yep.
There's a lot going on. I've had a number of people tell me this week about their concerns about the U.S. regulatory environment and how jobs and opportunity are being lost to foreign markets. So you just are back from overseas. Tell me what you see. And
let's focus on the positive, and let's take Hong Kong for example.
Oh no, let's not. What, are you kidding me?
So in Hong Kong, the regulator, with whom we actually had a great meeting last week, as an index company meeting with the regulator was a real privilege. They have laid out a path for exchanges and asset managers to have access to retail customers under a regulated framework. It lays out a number of steps they have to follow. Actually, one of those steps is that exchanges, when establishing their token eligibility, which tokens that they will allow retail to trade, those tokens have to appear on two independent indices, which of course is great news for us, but also a sign that the Hong Kong government the Hong Kong regulator is being very practical about how to guide those exchanges towards token eligibility, which is going to meet investor demand, but also have some level of objective observation and surveillance.
Investors are, they may live in different countries and such, but ultimately they kind of want the same thing. They want that ubiquity that I talked about. They want something we can all agree on. They want transparency, and they want trust and reliability.
That's right.
Is there some secret sauce?
There is no secret sauce. People will stick with what they're familiar with, right? And in the United States, over 50 million U.S. citizens have digital asset exposure or have digital asset holdings. So it's not as if this is remaining a very niche kind of, back corner sort of operation. There's tens of millions of Americans who have crypto. But for it to, at least in the United States, when you think about retirement money or you think about brokerage money or advised money, right? People want to have their digital asset exposure integrated into portfolios so that they can understand the benefit. So in those cases, the effect of owning digital assets on the portfolio is really going to start to really hum when there's familiarity, integration, and people can look at a long list of assets and almost not even be able to distinguish right on that list of assets. Oh, that's my commodity exposure, that's my equity exposure, that's my rates exposure, and that's my digital asset exposure. let's look at how this portfolio performs.
I'm visualizing the famous asset allocation pie, and that the digital asset is looking, I don't know what color it's going to be, but it's looking to get a toehold in there. And I'm guessing that broader use and uptake and agreement around benchmarks is only going to make that more likely.
That's what CDI is really trying to do the most. We want to be the world's most trusted index company, so that when traditional finance, the advisor community, the regulatory community, market structure, derivatives exchanges, banks start to green shoots spring up and new activity starts to happen, trusted, well-designed and well-regulated, well-governed index processes are going to be in demand. And that's exactly the demand that we want to meet.
I mean, I can't think of a widely followed index that doesn't have an ETF. Like the leap from index creation and all the work and lifting that goes into it to putting together a passive ETF is like nothing.
Right. That's right. Now, and ETFs are great, right? They're probably one of the most significant inventions in financial services since I started in the business way back in the 90s. They're a very comfortable, familiar instrument. Institutions use them, advisors use them, people use them individually, retail use them. And so this ongoing kind of effort to get a spot Bitcoin ETF to join really the financial the financial services kind of main factory continues. We believe that it will ultimately be successful. Of course, that just gives you access to Bitcoin, and then what happens next is the question. But look, we're very excited about that first step, because that will be a major step in what we were describing before, is this move from early adopter phase to early mass adoption.
I'm going to read this question, Andy, because you were tweeting about your appearance here at one of the panels, and it says you're going to be involved in a session on bridging the intuition and analysis gaps between TradFi, traditional finance, and digital assets. Wow. Give me a translation on what's going on there.
That sounds pretty fancy, doesn't it? So
that was probably an hour-long session. So.
People still need to understand the investment case for Bitcoin. People still need to understand the investment case for Ethereum. Actually, they might be discussed in the same conversation, but they're actually quite different. Bitcoin as a currency, as a store of value, as something which should have its own correlation properties to other asset classes, as an asset which has reaction to real interest rates, to global supply and demand, to geopolitical events, to permissionlessness, right? All of these things make it something which, as a diversifier and as a potentially upward price-moving asset, right, has a tremendous opportunity to perform and help to improve portfolios. Going back to ETFs, one of the great things about ETFs is they let people easily expand into different asset classes. A lot of people have their treasury rate exposure by ETFs. They have their commodity exposure by ETFs. They may even have currency exposure by ETFs. So that kind of wrapper, that kind of format is going to make it easy for advisors and retail to make their portfolios more robust, right? When it comes to Ethereum, it's a little bit different. You're not only thinking about Ether, the token itself, and its commodity value, the fact that it's the currency that's used to pay for all these wonderful smart contracts that exist now and will exist in the future. But the Ethereum network is almost like an app store. There are all these different protocols growing day by day and proliferating more and more, which are going to do fantastic things, which are going to be transformational, just like the internet was transformational, just like mobile phones were transformational. These applications, these things which save us time, improve efficiency, improve speed, reduce paperwork, these are all going to spring up on Ethereum. Paying for those is going to be in Ether. So the case for Ethereum is not only the token itself, its commodity value, but on the growth of all of these transformational technologies. And in fact, the third part of the Ethereum investment case is now Ethereum has a yield, which over the last couple of years has become more and more transparent and more accessible. So you have this asset which has a yield, which has a growth case, and it has a commodity and currency value. You add that to Bitcoin, which has these giant, very visible and very consistent macro drivers. You have these two assets which you can add to a portfolio, and it's hard to see how that doesn't improve certain portfolios and make them more robust.
You feel like your job today, you mentioned your derivatives roots in the 90s. That was like the Wild West back then, right? You were like probably out in Manhattan telling people like, wow, that's crazy stuff. Is it similar what you see now, and what you see is not only as an opportunity, but as sort of the the skepticism.
I'll tell you the
ignorance maybe.
The number one relationship that I see between my old days in the derivatives markets,
aside from the gray hair,
the gray hair and the loss of eyesight and all these other things, the scars everywhere, the talent that's in the digital asset industry right now is reflective of the kind of talent and ingenuity which really got the derivative markets going way back from the late 90s, when interest rate swaps were in place, swaptions were in place, but the credit derivatives market didn't exist yet. The equity, there weren't even really S&P 500 options. There were S&P 100 options, right? The innovation, the financial engineering that helped improve, that helped bring new ways to repackage risk, sometimes to detriment, like in the financial crisis, but often in a way which just improved liquidity and improved the completeness of the market. A lot of that talent has found its way here. In the good case, you have experience, you have regulatory experience and kind of regulatory, I guess, personal values which can be brought to the market. You have risk management skills, you have risk-taking skills. So when you think about the over-the-counter options market in crypto, it functions very well. When you think about the loaning market, you have had some stumbles, but you also have had some success. When you look at the DeFi market, a lot of folks are doing really, really clever things to replicate the best of traditional finance on chain. I'd say that the talent is the thing that is most enjoyable about working in this industry.
Interesting. I mean, you mentioned, risk and all, and that seems to be one of the tripping points for crypto, Bitcoin, et cetera. And so, I mean, risk is always the thing you don't see. Like what keeps you up? What's your worry right now? And not just you personally, but you collectively, your little niche, your little corner of this market.
No, that's right. I think that I don't worry about Bitcoin and Ether. I think that they're widely viewed. I think that they have a lot of smart people who want to make sure that they continue to fulfill their mission. I think that what I used to be concerned about, or I used to look at least with very closely, is how volatile Bitcoin used to be. Now I look at it and say, wait a minute, it's much less volatile than maybe it should be. Trading volumes are lower. Options volumes are lower. The volatility of Bitcoin is not that far away from the volatility of equities, whereas 18 months ago, it might have been 2 or 3 times as much, right? And in 2021, it might have maybe even 4 and 5 times as much. Volatility isn't always bad, but volatility always speaks to action, to trades taking place, to volume, to movement. Now there's less movement. My concern is that the lethargy about the regulatory process is just slowing things down so much that it's sucking air out of the room domestically. And as we said before, when we think about the price of Bitcoin, we think about its price in US dollars. When we think about its price in US dollars, we're thinking about the large exchanges here in the United States. A lot of the big, amount of the trading of Bitcoin and Ether still take place in the United States. So the listlessness of the trading range, the lower volatility, the lack of volume, the lack of volume support for the tokens is what I think is holding us up right now. Now, of course, that's drifting down to alt tokens as well, which are even less and less liquid, which really need to have their story and their narrative and their packaging reinvigorated. So I think that the market needs a bit of lift. Right now, everybody in this room here today is thinking, well, the biggest thing that's going to change that mood is the approval and the proliferation, the success of Bitcoin ETFs. That could be one thing. But we at least need that to get the market kind of out of the mud hole that it's in right now.
Well, I know you guys got a lot of announcements coming up, so we'll definitely be in touch and hear from you. But we've got the bullish case from Andy Baehr.
Yeah,
interesting. Great to have you on. I appreciate you coming on. Andy Baehr, Managing Director of CoinDesk CoinDesk Indices. For Kitco News, I'm Matt Nesto.
Kitco News special coverage of Messari's annual Mainnet Summit is brought to you by Oasis Pro,